Hello. Today we have a special guest. We have a mortgage broker. We have a Rhett McClenaghan. He's going to giving us about insights in the mortgage world, what we're going through right now. Rhett has been a mortgage broker for 18 years, and he has been a financial planner for 24 years. He's a frequent award winner in the industry of mortgages. In 2019, 2018, and 2017, he got the Platinum Award and also has been included in the Hall of Fame. He has been growing his financial center for the last years. He's a graduate from the University of Lethbridge in Alberta. He's a mortgage agent broker. He's an insurance agent, he's income tax trained, he's mutual fund licensed, and he was his code leader for 20 years, so it's a well-expanded resume. So we are very excited to talk because there are so many changes that we are going through right now. So welcome, Brad.
Thanks for having me.
Okay, last year we hear so much about the stress test. Because the stress test was implemented, now I can have the amount of mortgage that I used to have. Can you tell us what is a stress test? Because so many people are talking about it, but sometimes we know so little about it. Can you give us your insights? Can you give us an explanation what is a stress test?
Sure. So the stress test was designed by the government a number of years ago because they're worried about people affording their mortgages. So what they do is, let me give you an example which will illustrate the difference. So for example, if you make $50,000 and your current interest rate is say 3%, based on before the stress test, your approximate maximum approval would be about $270,000. But now that they've introduced the stress test, even though your interest rate will still be 3%, we have to use right now 5.04% interest rate to get you approved. So what that does is it reads the maximum mortgage that person could qualify for to $220,000. So overnight, that was a difference of $50,000 that a person could normally be approved for, but is no longer able to. Now, there are some things that we can do to perhaps into the middle, maybe in the 250 mark, but usually that means you have to increase the interest that the client pays.
Okay, perfect. Yes. Yeah, we all know we're going through hard times right now, right? And when hard times hit, having a line of credit comes very handy. The most popular line of credits that we hear all the time is a line of credit and a secured line of credit. Can you define me the difference between the two?
Sure. So lines of credits, there's two types. One is a regular non-secure, and then there are secured line of credits. A line of credit is mostly approved on your credit score and your debt ratios. And there's no collateral. So the banks are very tough on these approvals. Now, because they're unsecured, the interest rates are going to be higher. So normally, you're going to get prime plus 1.5%, maybe up to 3.5%. So your interest rate is going to be around 4 to 6%, depending on the bank. Now, if we would decide to go secured, which means they're going to use your house as collateral, like a mortgage, and they're able to put it on, register it on your house, then you get a cheaper interest rate. So currently, the rates on those would be prime plus 0.5 to about 1%. So then you're getting a rate below 3%, say 2.95, up to about 3.45. So it is certainly cheaper from an interest rate standpoint to get a secured line of credit, but there is a cost for doing that because it is registered against your house. So a lawyer has to be involved in order to register that mortgage. And there are rules about how much line of credit they can put onto your house.
Okay, so that means, let's say I have a secure line of credit on my house, and I decided to sell the house. So that means automatically when I sell my house, it's going to be paid the mortgage and at the same time the secure line of credit?
That is correct, yeah. Anything that's registered on your house has to get paid off, including, for example, let's say you bought a furnace and they secured the house with, your furnace, then that has to be paid off as well.
Okay, yeah, okay. And there are many lenders out there. We all hear A lenders, B lenders. And sometimes people think that the only way to get a mortgage is through the bank. But I know there are other venues, especially when they are self-employed, sometimes they don't have all the income. Can you mention what kind of lenders are out there?
Sure. So we have A banks like TD, Scotia, First National, MCAP, Dominion Mortgage, etc. They'll typically give you the best rate with no fees, but you have to their tough rules. They always want good credit. They want to be able to have confirmable income with either job letters, confirming income, or average tax returns for self-employed or part-time employees. So they're more strict with the rules, but they'll give you the best rates with no fees. If we're struggling on a deal, then we have other options. So we can go into what are called B banks. B banks typically charge a little bit higher interest rate, maybe 1% more. You're going to get a shorter term mortgage, maybe 1 or 2 years, and usually they charge a 1% lender fee. But the benefits of going to a B bank is they'll do self-employed people who maybe haven't filed their taxes, or maybe if they have filed their taxes, their tax returns aren't looking that great. They may do deals for people who have challenged credit, late payments, collections, discharged bankrupts, even some people with bankrupts. And then we can go into the C banking, where they'll do things like student rentals, and they'll do bankruptcies. And then we get into the private world as well, where private, they don't really care about your income, your credit. If you have equity in your house, they'll loan you money. So we have the whole range from AAA stuff all the way down to private. And depending on your situation and what you need the money for and what your situation is like, we have pretty much a solution for everything.
Perfect. So just in case people out there think that because they don't declare enough in their taxes, or they might think that they are not approved or they can't approve, but clearly there is a solution for any specific need that somebody might have.
Yep.
Okay. These two words, I remember I hear them, I don't know, I think it was the first time I bought my house. I never heard these words before. And I hear the words conventional mortgage, and I hear the word high ratio mortgage. Now I understand, but can you please explain to our viewers what's the difference between conventional mortgage and high ratio mortgages?
Yeah, so this gets very confusing for a client, because from a client standpoint, they think if they put 20% down, they're less of a risk for the bank, and therefore they're going to get a better interest rate, but that's actually not true. So what has happened in the market, and the government made this change a couple of years ago, is when you're buying a house and you're going to put less than 20% down, then that's considered what's a high ratio mortgage. Okay, and in doing so, the bank has to do an approval, but they also have to get an approval through one of the insurance companies. And the two main insurance companies that we use here in Canada are CMHC and Genworth. And so they have to get 2 approvals. And with that, you have to pay an insurance premium, okay, of say around 3%. So if you have a mortgage for $200,000, they're going to add a $6,000 insurance premium because you did not put 20% down. Now, with that mortgage, you're going to get the absolute best interest rate. Now, if you decide to put 20% down, then it changes from high ratio to a conventional mortgage, which means not insured. And because it's not insured, because of the government changes, it's actually more expensive for a bank to do a non-insured deal. So what the crazy thing is if you put 20% down, you don't have to pay the 3% or so insurance premium, but your interest rate is going to be higher than if you were actually only put 5% down. And so it's very confusing for a client, because from our standpoint, we think that it's all about security, but to the banks, it doesn't matter about security. It's all about how much it costs them to get that mortgage for you. So that's why it's a bit confusing for
But the good news in all of this is that, let's say I don't have the 20% down, I can still buy a house, right? So those are good news.
Yeah. And what's confusing about this whole thing too is that all refinances now are considered conventional. And so anytime you do a refinance, you're going to get a higher interest rate than if you were to buy with only 5%. And this is what's confusing for a client, because they'll come to me and say, hey, a house, lots of in it, and then I quote them a rate, and they're like, what are you talking about? I can go anywhere and get cheaper. Well, you can get cheaper, but those are purchase rates, high ratio purchase rates, and it's very confusing for clients.
Very good to know. When we go to refinance, now we know, right? Very good. I noticed for my clients, they are so drawn to interest rates. This bank is offering me 0.25% less. That bank is offering me 0.25% less. They are so drawn to interest rates. Will you agree or disagree that interest rates is not that all what it matters when it comes to mortgages?
Well, it is always nice to have the cheapest interest rate for sure, but there are other things that you need to take into consideration. And the two big things that you have to look at with any mortgage is their prepayment privileges and also the penalties to break their mortgage. So for example, some banks will allow you to do extra early payments on your mortgage by only 10%. Some actually go 20%. So there's a big difference between how fast you can pay your mortgage. With regards to penalties, who you pick as your mortgage lender is really important. For example, the big banks like the TDs, the Scotias, RBCs, Bank of Montreal, etc., when they calculate their penalties to break their fixed rate mortgages, those are typically the most expensive breakage penalties. So it can add up to more than $10,000 to break your mortgage with one of those big banks. If you go and get a mortgage from a mortgage lender, what's called a monoline, it'll have the same privileges, etc., as a big bank, but the way that they calculate the penalty is significantly different. And so it could be a matter of an $8,000 difference in penalty if you need to break your mortgage earlier. Typically, in my business, I try not to sell from the main big banks with their fixed rate mortgages because of the penalties. Now, we do a lot of business with them, and sometimes we have to go to them. But if we do, I just make sure that the client understands the penalties and the prepayment privileges that are, inherent with some of these products so they don't go in blindly. And then there's no surprises if they have to sell or do something in, say 3 years instead of waiting all the way to the end of the 5 years.
Yeah, I completely agree. It happened to me before. I went with one of the big banks. I think it was, 15 years ago. And my penalty when I sold the house was $12,000.
Oh.
Yeah, I remember. Yeah. So that's why I don't think when clients tell me, oh, the interest rate is better in that bank, I'm like, okay, let's talk more about this. And I always say, go to a mortgage broker and talk your situation, and then they are going to explain you what is better or what is not. But the prepayment privileges and also the penalties, trust me, penalties is a factor, very important factor that we have to look into it. We all know that right now we are going through very, very difficult times, different situations. People are working from the house, kids are at home, so it's harder. We know it's hard. And before, the only word that I used to hear was first mortgages. And then after, I started hearing about second mortgages. And lately, I've been hearing, I didn't even know existed. I've been hearing about third mortgages. So we have first, second, and third mortgages. Can you define me the difference between the three?
Yeah. So first mortgages, so what happens is you can have kind of as many mortgages on your property as you want, as long as you have willing lenders. What happens is when your house gets sold, the first mortgage always gets paid off, and then whatever's left then goes to the second mortgage. The second mortgage takes what they need to get paid off, and then goes to the third, and so on. So if you're a second or a third mortgage holder, there's a lot more risk for being in that position because you don't really have control of what's happening. So if the client, if the first mortgage is going to, go power of sale and sell that house, the second and third mortgage is a bit worried because the first mortgage could sell for whatever they want, making sure that they get paid, and they don't really care about them in third. Now, we do a lot of seconds and thirds because a couple reasons. So number one is perhaps the person has bad credit, or they just need temporary financing, or of course with these new strict rules, the mortgage company is just not approving them, but they have equity in their house and they would like to take some money out. So we can do seconds and thirds, but the interest rates go a lot higher. So if you're getting a regular interest rate of 3% on a first, if we try to go second, most likely into the private mortgage industry. And when you go private, the interest rates on privates are usually between 12 and 14% on second mortgages. And you kind of say to yourself, wow, that's expensive. Well, if you consider that a lot of these times when we're doing these second mortgages, we're paying off 20% credit cards, 28% Tepperman's accounts, maybe you got a Leon's account, maybe you got a Best Buy account. All of those are 28, 31% interest rate. 14 is not too bad when you're paying off those high interest rates. And most of the time when we're doing seconds, it's because there's an issue qualifying. So the banks aren't going to give them money and they're struggling with their payments. And so it makes a big difference when you can perhaps get that second or third mortgage on the house to just help them pay their bills and get things taken care of.
Very well explained. Yeah, let's say I have a credit card that is charging me 3% interest rates. At the time, it might sound, oh my gosh, 12, 15%, that's too much. But when you compare to 30%, we are talking about less than half of what they can pay now with the second mortgage. Yeah. A lot of options out there, right? There are also, I always say that you don't ask, you don't know, right?
Yep.
During these hard times of COVID-19, can people still apply for line of credit mortgages? If they can do it, how they do it, how they can get in touch with the mortgage broker?
Yeah, so yes, the mortgage industry is still open and still working. We're considered an essential service. So what's happening now is all the lenders are still running under the same policies. The only thing they're looking more for is your income. So if you're laid off, they want you to be back to work before they'll do a mortgage for you. If you're self-employed, they're looking for proof that you're still doing business right now, that you're not shut down. And so they're going to be looking for a little bit more documentation and confirmation that your income is actually current and active. If you're getting the CERB benefit, the $2,000 a month, or if you're on unemployment temporarily, they will not do a mortgage for you. And so you're going to have to wait until you get called back to work. And the moment you get called back to work, then we can close the mortgage. So we could get the approval now, get it all ready to go, and then we just have to wait. And then 2 weeks after you get back to work, we can kind of close the mortgage. And so we're doing a lot of that now, because we are going to get back to work. And they're going to get rid of the pay cuts.
Yeah, we're going to get back to work. I wanted to get back to work. I wanted to get back to be in front of my client. Yes. So but still they can send all the paperwork. They can do something in advance, right? Paperwork, T4s, notice assessments, so they can start getting prepared. So when the time comes that you go back to work, then all the paperwork is there.
Yeah.
Okay. Before you mentioned about, you say the word refinancing. Some people, they don't have, at the beginning, I couldn't even understand what refinancing was. I was like, what? Refinancing? Can you tell me what is a refinancing? What is it? Like, do I need to sell my house? Do I need to stay with the same lender? Do I move to another lender if I do refinance it? Like, what is it? How can I do it?
Okay. So a refinance is available for clients who have a house, they have a mortgage, and they actually have a bunch of equity in the house, which means, let's say, for example, your house, if you were to sell it, is worth $300,000, but your mortgage is only $150,000. So you have $150,000 worth of what we call equity, home equity. Now, the home equity is sitting there, and normally the only way that you can get access to it is if you sell your house. Well, mortgages is one way that you can actually get that equity out of the house. So under the new rules, you could do a new mortgage on your house for 80% of the value of your house. So if your house is worth $300,000, then you could put a new mortgage on your house for $240,000. Now that new mortgage would pay off the old mortgage of $150,000, and you'd be left with the difference, and the lawyers would give that to you. Now, there's lots of options for refinances. So one option is to go back to the bank that you're at and ask them to do a refinance. Sometimes that's a good option. Sometimes you get a better interest rate if you actually go and get a new mortgage and pay off everything. We have to take into consideration what the penalty would be to break your mortgage, but we would work through those numbers and make sure what makes sense. Sometimes you can't get regular financing, and so then we'd have to go into the second mortgage. So which means we're going to keep the first mortgage just fine, not change it, not do anything with it. You'll continue to pay for it, and we will add on a second mortgage, or maybe we'll add on a line of credit in behind to give you access to some of the capital that's in your house. One of the values of doing a refinance is to get that money to do a bunch of different things. So a lot of times we do it to pay off higher interest rate debt. So for example, if you have a $20,000 credit card, balance, normally your 3% payment would be $600 a month.
Mm-hmm.
And normally if you're paying, let's say, an average of 20% a year, okay, you're paying $3,600 of interest every year just for that credit card. If we were to convert that credit card debt into a mortgage at 3%, it drops the payment from $600 a month to $94 a month.
Hmm.
And instead of paying $3,600 in interest, you're paying $578 of interest. So that's a huge difference just with regards to high interest credit cards and putting them into a mortgage. In this particular case, the person is saving over $500 in payments per month, so they have a lot more cash flow, and they're saving over $3,000 of interest just on that one credit card of $20,000. So you can imagine that if you've got a few credit cards and maybe a car loan, and a couple other things, the amount of savings that you can have every month is just huge. And so refinances can make a big difference to your monthly cash flow, enabling you to save for retirement, put money away, pay for your kids' education, and just give you a peace of mind that you're not going from, week to week, with your income, that you have a little bit of flexibility, maybe save for a rainy day. Like imagine if you didn't have that. If you had that extra $500 for the last year and you put that away, you'd have $6,000 in your bank account that could be used to weather this storm of COVID.
Exactly.
We're going to get through this COVID problem, but I'm pretty sure it's going to happen again. Something's going to happen. It's going to happen. And so you need to be prepared for situations like that.
Yes, I always mention that to my clients, be prepared. And you always apply for credit when you don't need it, right? Because when you need it, tell me the experience I'm talking. It happened to me before. So you always apply when you don't need it. So when something happens, and then you are prepared, right? Okay, let's now talk about it. Let's say I have a client, and this client has saved money, and the client has do his due diligence, and he's gonna be looking for a mortgage broker. And what do they need to look for when are looking for a mortgage broker? When I do insurance, and when I go to see my clients, I always tell them, okay, it doesn't matter, you get it with me, with somebody else, but make sure you look for honesty, experience, and integrity. So when looking for a mortgage broker, what should I be looking for?
Well, those three things are great. Those are kind of, anybody that you work with should have those three qualities. But in addition, in particular with the mortgage industry, bigger is better. And what I mean by that is if you're working with a mortgage agent with a small mortgage company, then you're not going to have as many options as you'd have with a big company. So, for example, with myself, my franchise is with Dominion Lending Center. Now, Dominion Lending Center is the largest mortgage brokerage in Canada. And why that is important is because we now have access to every single lender out there where other smaller outfits wouldn't have. And the reason why is because you have to do volume with each lender, enough volume with each lender in order to get their spec and their interest rates and etc. And because of our size and the amount of volume that we do, we're able to negotiate better interest rates, and we have special rates that are available only to us. And the third thing is that we have access to more in-house options. So we have our own private lenders, we have our own special programs that only our agents have access to. And so again, it just gives more options with better interest rates for our clients. And so that's a big value of, you know, what you're looking for when you're trying to decide between a mortgage agent between different companies.
So here we have, so for people that are looking for, or they're going to be in the market for a mortgage broker. So here we hear what they need to look for. Right now, with the situation that we're going through, we don't know how long this can last. It can be 1 more month, it can be 2 more months, it can be 1 more week, right? Are there any plans out there that lenders have implemented for people that, let's say, I can't pay my mortgage? I finished my line of credit, I maxed my credit card, I'm like done. I can't pay my mortgage now. Are there any plans that lenders have implemented? And if there are those plans, do they have any consequences?
Yeah, so all the lenders have come out and said to work with clients to do their payments for up to 6 months. Now, deferring just means you're postponing the payment. You're eventually going to have to pay for it, and it's not free. The lender does charge interest on that missed payment, so you're paying interest on interest. So again, you got to remember, with the banks, nothing is free. But it is an option in an emergency situation where you just don't have the money on a one-on-one balance. The problem that we're having right now is all the lenders are just being, the volume of phone calls is just tremendous. So it is going to be very difficult for you to get a hold of your lender. So please, give your mortgage agent a call, and he can help you with figuring out which exact number to call, because some lenders have brand new numbers just specifically to deal with this. Sometimes they have special emails that are set up, different ways of trying to get this deferment, and just be extremely patient. One of the problems, people are calling their lender 5-6 times, leaving 5-6 messages, 10 emails, and that's slowing the process down because their credit team has to actually listen to and deal with every single phone call and message. And of course, some of those are duplicates, and it's causing wasted time. So I'm just letting you know that if you send an email, if you leave a message, they will get back to you. Now, a couple weeks ago, it was about a 12-day turnaround between the time you left a message to the time they responded back to you. Now, they're getting much better now because they've shifted people in different resources in their companies over, and they're doing phone calls. But they, of course, were not prepared to handle the volume of phone calls, and they just got overwhelmed with phone calls. And so, but just know that it is an option for you. Now, yeah, another option would be to use, maybe if you have an existing line of credit or a credit card temporarily, to pay for it. One of the things that I worry about is that if you just don't pay your mortgage payment, the credit system is going to hurt your credit with a late mortgage payment, and it's going to be registered on your credit bureau. And that is really hard because lenders typically do not lend money to clients who have a late mortgage payment for up to 6 years. So if at all possible, borrow, beg, something, get the money to pay that mortgage payment, just to work with your lender to get them to postpone that payment. Because if you just decide not to pay for it without their permission, they will hurt you with a late mortgage payment, and that could affect your ability to do any kind of mortgages for 6 or 7 years. So just be careful, be very patient with the lenders. They will work with you. They all will defer payments for you. You just got to be patient and waiting for them to get a hold of you.
Thank you very much for that piece of advice. I did another video, 10 ways to save money, and I mentioned that if you don't have the money to pay your mortgage, make sure you contact your mortgage company, your lender, and advising and make an arrangement, but figure out, but that just don't skip the mortgage payment. Thank you very much. So I want to appreciate your time. Thank you so much for joining us. I'm sure all the viewers are going to find your insights are very valuable. As I mentioned before, our conversation today was with Rhett McClenaghan. He's the mortgage broker and office manager of Dominion Lending Center. And also he's the director of R&D, Insurance and Financial Services. He's a very well-known mortgage broker in the London, Ontario area. And thank you very much for your time.
All right, have a great day. Be safe.
Bye.